Hi, everybody, and welcome to this panel discussion at GTR. Quite, quite an interesting topic that we are going to discuss uh, with panelists in different scopes of their work. So purely, we are going to discuss on post-COVID or this trade-led growth and what is the role of ESG. And the question that we are going to discuss in the panel is how will Asia strike the balance? So in the panel, we have a very good team of people from the corporate sphere, people from legal, from research, and some very experienced bankers. So I would like to welcome Gopul Shah, who is the Director, Head of Global Treasury and Trade Finance at Golden Agri. We have Neha, who is from Bank of America in India. We have Matthias Schemuth, who is a partner at DLA Piper. And we have Kamran. Welcome to Kamran. He just comes from COP26, and it's the right time for us to have him in this panel to get his inputs on what was the real discussion on what came out of it. And definitely we have Stephen Olson from the Hinrich Foundation, who is a senior research fellow, and purely his inputs will be extremely vital. So let me start with the discussion, especially with the expertise of Stephen on certain things like the STI index. Stephen, I leave the floor to you to let we discuss on this particular aspect of ESG.
Well, great. Well, thank you very much, and good afternoon, everyone, or good morning or good evening, as the case might be. On behalf of the Hinrich Foundation, I'd like to very sincerely thank GTR for their kind invitation. It's a real pleasure to be here. Now, I have just two slides that I'd like to share with you. So as long as the technology gods will cooperate with me, hopefully I will not have any issue getting these up for you. Okay, I believe that has worked. All right, so what I'd like to do today is take just a couple of minutes and talk to you a little bit about the Hinrich Foundation Sustainable Trade Index, or STI. Now, probably the best place to start the conversation is with a definition of exactly what we mean when we refer to sustainable trade. Essentially, sustainable trade means engaging in international trade in a way that not only generates balanced economic growth, but also strengthens social capital and provides for environmental stewardship. Although we recognize that trade is an essential ingredient in economic development, it cannot be pursued sustainably. And I would really triple underline that word sustainably without an equivalent commitment to social capital and the environment. Now, of course, these principles are based on the landmark work of the 1987 UN Brundtland Commission, which first established those three pillars of sustainability: economic, social, and environmental. Now, in terms of the STI itself, it evaluates the trade sustainability of 19 Asian economies, plus the United States as an external benchmark across those three pillars: economic, social, and environmental. It was based on a comprehensive literature review, a series of expert consultations, and several of what I can assure you were highly intensive workshops that we convened at the Hinrich Foundation offices. So where we ended up with was with an index that contains 15 indicators under the economic pillar, 5 under the social pillar, and 7 under the environmental pillar. Now, a very important point. After a lot of discussion, after a lot of debate, we ultimately decided to weight each of those pillars equally. So economic pillar is worth 1/3, social pillar is worth 1/3, environmental pillar is worth 1/3. Now, if you think we got that wrong, if you think we made a mistake, you can download an interactive version of the workbook at hinrichfoundation.com. You can reconfigure those weightings in whatever way your heart desires, in whatever way makes sense to you, and then you can rerun those results. And I would strongly welcome and encourage all of you to do that. Now, finally, and to conclude, although I won't go into any significant detail in terms of the results of the STI, I just wanted to highlight for you one of the key messages, and that is foreign direct investment is going to play a critical role. Governments simply cannot meet their sustainability commitments and aspirations on their own. And in particular, with regard to the SDGs, the Sustainable Development Goals, governments have been remarkably transparent in saying, look, we are going to need private sector partnerships to get this done. So as we think about the post-pandemic world, as we think about our sustainability agendas moving forward, it's clear that responsible and mutually beneficial foreign direct investment are going to be a critical piece of that jigsaw puzzle moving forward. I'm mindful of the time, so I'll bring my comments to a conclusion there, but I'd be happy to explore anything in more detail during our Q&A and discussion phase. Thank you very much.
No, great, Stephen. Thanks for this wonderful, it's something new that even I have done today. Purely we will do go to, and definitely, as you said, the government does need support from the private sector to make this happen. So great. Now I would like also to ask, we have Gopul with us. Gopul is working with Golden Agri, and Golden Agri has been in the news for a lot of initiatives that they are taking on the sustainable side, especially being in the palm oil sector. I would like to ask Gopul, especially his corporate perspective in the ESG space and with trade finance as an asset class in Asia, and how does he see this market evolving?
Sure. Thank you, Tony, and a pleasure to be with you. Look, the balance is tilted in favor of ESG. And, whatever has happened during COVID and the geopolitical divide, which we have seen, has accelerated the trends. In the last few years, I think, as most of the NGOs have started to, educate us on environmental issues, we have experienced forest fires. We see garbage floating all around us, whether it's in space, whether it's in air, or where we live around. Maybe we may not see it. It sometimes is invisible, but that's a fact. And this has happened over the last 25, 30 years of, high growth, which we all work to achieve. So my view is that, look, in the next 5 years, the balance has tilted in favor of making sure that we all work towards better environment outcome. We manage climate change, decarbonize, make sure that, the social structure of the society improves, so as the governance at the corporate level. Governance, without governance, I don't think we can achieve much at the corporate level. And I think individually also we will have to contribute because we are all in together, So it has a huge ramification if we think about certain policies which or standards which are evolving, whether it is ESG standards, including standards around compliance as well as reporting, or scope 3 emissions, which is going to impact the supply chain globally, and decarbonization efforts around the business and around what is happening. But the key thing which I feel is the takeaway from COVID. COVID has taught us that, look, we are all together we have to work together as one. We need to collaborate, we need to cooperate, and make sure that, it's all about competition. Because, we can't say, X individual or X country or X company does something. So it will be something which is a global effort, which will be required, and every one of us will have to basically toe the line. Now, COVID has been a leveler. We have seen a lot of impact happening, but it has also been an accelerator for change. We have seen digitization, we have seen technology, being implemented, and all this is helped in a way. And I think these can be good tools, to achieve, the balance as well going forward. I'm not saying balance will be achieved immediately because, the priorities are very different today. But there are some catalysts for this change to happen when we talk about collaboration. So number one is technology investments, and as Stephen pointed out, is the FDI, which comes in, and public-private partnership as well. So that's one. The other thing is government actions. We are going to see a lot of stuff happening around, regulations, carbon trading or carbon taxes going forward. We are also going to see independent watchdogs, and agencies basically working to make sure that reporting and everything is aligned. And more than that, I think we need to educate. Look, Asia is very far away. Emerging markets are far away. When we go down to the grassroots level, we need people to be educated. We need to basically take self-responsibility, and I think that will be a big task for the government to do, to achieve something which is dramatically changing, how we live and how we operate. My message is that, look, we are all in together. Priorities have changed. Striking balance, we can think about it 5 years from now, but as of now, climate change, environmental, better environment and social life will be very, very important. And COVID has taught us, all of us, good lessons. And I think, if we fail to learn, we won't get another opportunity to make it right. Thank you.
Thanks, Gopul. Definitely, thanks for your inputs. Definitely, if time permits, I will also come back to you on one question on the supply chain finance side, vis-a-vis banks, that, with the huge amount of import and export, both legs that you have, I would like your inputs. How are you seeing evolution between banks and corporates? So I'll come to you later. Now I would like, now definitely when we talk about ESG and how ESG is becoming important within trade as an asset class, we come to the legal aspect. And definitely we have the entire legal framework across the globe, which is helping banks and corporates how to embed this ESG into the legal documentation. We are happy to have Matthias Schemuth, and I would give the floor to him just to give us a flavor of what does he see from a legal perspective.
Sure, thank you very much. Thanks. So I'd obviously like to talk about aspects more from the legal perspective and the practicalities we're seeing in transactions. Green loans have been booming. Sustainability-linked loans have been booming in Asia, throughout Asia. You can't attend a conference, a trade conference, without really hearing the ESG buzzword. It's everywhere at the moment. What we're seeing, first of all, in terms of challenges, the challenges in the development of this market we're seeing in Asia. One thing is obviously the cost to transactions. So in terms of documentation, putting together a deal, the additional cost of having an ESG compliant type of document, and in particular the independent certification that often goes with it, that's an additional factor that has to be taken into consideration. Another aspect is capital. It's very easy for capital to be found for certain transactions, renewable transactions, transactions in industries that are themselves green tend to be very easy and apparent. Industries that are in transition, a little bit harder, and to find the additional improvements or the sustainability aspects and to test them and to monitor them may be a bit more difficult for capital to be attracted to. So again, transactions are finding certain industries easier than others that are yet in transition. In terms of standards, we have very many different standards, from accounting standards to compliance with, in our loan documentation with the banks are all mostly equator principal banks, or banks that comply with IFC, environmental and social guidelines, ADB guidelines. We've got so many different guidelines. And then in the documentation, we also have Loan Market Association like LMA, APLMA, LTSA developing their own principles to be followed. So there's a process of education as well for everyone, really, in terms of what does this mean, what these labels mean, and how do we apply them? And importantly, how do we apply them uniformly? So just talk about that a bit more. So a lot on the standardization and awareness of what is happening. Then with regard to accounting and reporting, of course, we are still very much in the development stage. We're seeing a lot of progress being made with EU taxonomy, and jurisdictions in Asia starting to lean towards EU taxonomy, which is very advanced. China is adopting a lot of the principles of EU taxonomy and pointing in that direction. A lot of the monetary authorities in Singapore, Hong Kong, also taking steps to develop standardization for reporting. So those are some of the challenges we see. Looking at the legal documentation, we have, as I mentioned, so many principles. In 2018, we saw LMA, APLMA, LTSA develop the green loan principles. 1 year later in 2019, and then again in 2021, we had the sustainability, the SLL principles that were developed. Again, these are principles that are guiding concepts for documentation and concepts that have to be adhered to by market participants, but they are not legally binding. They are self-imposed rules and regulations to ensure that a transaction meets criteria and that is widely accepted in the market. But it's not binding. These are principles and guidelines. So we have a very big divergency of what the legal documentation looks like when we implement these concepts. So we know the key leading principles. When we have green loans, we look at the certification of how the loan proceeds are applied, what they're applied to, and monitoring that. For sustainability-linked lending, more flexibility about the use of the loan proceeds, and really creation of incentives for borrower to increase its environmental profile and to achieve improvements, meaningful targeted improvements in its environmental and social sustainability profile. So how do we document that? Again, there is no one and hard fast rule about that. The application to documentation is very diverse. Now, some corporations, larger market participants, have actually gone off and developed their own interpretation and their own policies and documents following some of these international principles, and they will go to the banks and show their policies and guidelines and documents. And then the banks often have, when we deal in documentation, the banks have their own environmental and social teams that we interact with, who have also developed their own policies. So we have, on the one hand, borrowers that develop their policies, sophisticated borrowers, and most banks have very active environmental and social teams within the bank who develop their policies. And again, that all leads to very diverse outcome of form reporting and what the legal documents look like. So we are still in this process at the moment of a lack of standardization and making sure that we understand what is meant and just a divergency of views. When it comes to reporting as well, as I mentioned, reporting, monitoring, there's no hard and fast rule. There is no singular approach. Again, we have quite a divergent approach at the moment, how we report on compliance and what is meant. I can talk later about other things such as where the market is heading and what products are being developed, if that's helpful. But yes, at the moment, that's hopefully a good starting point.
Yes, definitely. I think thanks for your input. I think we will come back to you on what are the products, because this is a very important information that our audience would want to know on what are the products being developed. And since you talk about banks, we are happy to have Kamran. Kamran is the head of Asia Pacific for ESG at Deutsche Bank. He was recently attending the COP26 at Glasgow. So definitely, Kamran, we give the floor to you for your valuable inputs on the banking space, plus what are your takeaways from the COP26 summit.
Thank you. Thank you very much to all of you. It's a pleasure to be on this panel with all of you. Let me just make a few points and then we can get into our discussion. First, before I get to COP26, I want to just make sure we put the frame right for our audience. And this is about how quickly this market is evolving. Just to give you a perspective from our side, Deutsche Bank, and this is applicable to almost all banks, and other colleagues I'm sure will confirm this. Just to give you a sense, last year we announced our goals in the ESG space to do 200 billion euros by 2025. We made so much progress in 2020 alone, in the 6 months that we had in 2020 since announcing, that we had to bring those targets from 2025 to 2023. we very recently announced that in 2021, at the end of Q3, we had already surpassed 125 billion euros. So, you can now see, and like I said, this is not just us. The entire industry is going through this. Clearly, some banks more so than others in terms of market share capture, but it's a big trend. And Asia, we believe, is at the heart of all of this. And here's why. So you were mentioning COP26. I can tell you 70-80% of my discussions on every panel, every debate were about the role of Asia in this ESG debate. So how does this Asia fit in? In terms of a trade finance perspective, we know that Asia is the sourcing capital for almost all global supply chains. So this is, when you talk about sitting in your HQ in North America, Europe, or in Asia, but certainly in North America and Europe, this is the area where you have the least visibility around how is your business impacting the local economy, the local social fabric, environment, and so on. So it's not really, when we look at Asia, we don't look at Asia from a perspective of, okay, what do we do in Asia? What do we finance in Asia? And then what did we do in Europe? We look at, we're a global bank. I would say vast majority of our clients are multinational corporations. So we engage them as one firm and as one bank. And then it is our job to help them provide clarity on what their businesses are doing in Asia, all across, and other emerging markets. And that brings me to the key element of all of this, which is you can't copy and paste European rules or increasingly now US rules to Asia. So what gives? We know we can't copy and paste, but you also don't want to dilute the rules for Asia. Then there would be no point in doing this whole ESG thing. So the role for a global bank like us is to be able to understand the rules and the materiality of what those standards mean, have the understanding and experience of how they can be applied to the ground realities in Asia, and then have the gumption to ask our clients and our own teams to provide evidence and data to substantiate the claims, right? That's the heart of the challenge, and that's why we set up our ESG Center of Excellence here in Singapore, not in New York, not in Frankfurt, not in London, but in Singapore, because we feel that if we can get this right in Asia, it goes to reason that we will have very simple task of getting it right in other jurisdictions. And the last thing I want to end with is some comments on trade finance. So how is it applying? So I can tell you we are heavily involved, all kinds of live deals, live engagements, closed transactions on ESG in trade finance. And the top of the top firms globally are now looking at, you mentioned supply chain. So they are looking at, okay, how do we get ESG ratings of all our suppliers? We're working on these things, differentiated pricing on supply chain finance that are indexed to the ESG rating of a supplier. And then variety of customizations that are going in to really connect fintech, ESG, and trade finance. I always joke with our colleagues, our trade colleagues, to say, I cannot believe we're in 2021 and we still use instruments like letters of credit. Just think about it. Letters of credit. We're still using letters. They've been using that for centuries. Surely we can move to a more digitized transaction model. And that means we, the banks, have to come up with new products and more sophisticated reporting procedures, because our regulators are asking for all kinds of information now. So anyway, I'll stop here, but the regulation and reporting of non-financial data is going to be a massive market and a key challenge for corporates, banks, and regulators?
Yeah, thanks, Kamran. Thanks for your input. As we speak, I think this for this panel, I see we are getting a good lot of questions already coming our way. So before I go to Neha and we get a perspective, Neha is in Bank of America. She's based in India. So I think definitely we'll get a lot of things happening in India. Overview from Neha. I think since we are here, one question that it comes to us is carbon taxes, do you believe they are the answer? Perhaps any opportunity to tax the public at large through the issue of pollution needs to be addressed. So basically, carbon taxes, is it the solution? So this is one question from one of the audiences. So I would like either Matthias or Kamran, anyone to take this for our audiences.
I'm happy to take that, but don't you want? I want to make sure that Neha puts the frame on the table as well. I'd love to, and then we can maybe do the Q&A if you don't mind. I'm just thinking, but I'm happy to answer that question.
Yeah, please go ahead, Kamran.
Okay, so you all must have heard that the biggest negotiation, the last thing that was negotiated at COP26 was what is called Article 6. And Article 6, a lot of people are unhappy that it did not deliver as much as people expected in terms of targets. What it did is it achieved two things, which are, I think, relevant for all of us here. One, the world is trying to hit this 1.5 degrees temperature rise target. So can we curb our emissions to a point where the globe does not expand beyond 1.5 degrees? We didn't come up with, the sovereigns, the governments did not come up with enough of the target setting, high enough targets to assure the scientists that we will stay within 1.5 degrees. But they saved the day by saying next year the sovereigns can come back and increase their targets and therefore perhaps catch up to the 1.5 degree goal. It doesn't mean we got it, but at least they kept the hope alive, right? Which a lot of young people, as you can imagine, would have been, bitterly disappointed. And certainly the experts, if they had come out and said, no, we will never make the 1.5. Obviously, there are scientists who think we are already past 2.4 degrees temperature rise. The second important thing was on carbon trading. So there was this whole debate around, is it a panacea? Is it a model we will adopt? What the governments came out with is a commitment that, yes, carbon trading is one of the avenues for reducing emissions, that it has a multiplier effect, and that each government then committed that they will put in place legislation and rules and regulation for this kind of trading to take place. Okay, so that's very good news, because what that means now is going forward, work is going to be done on how do you define standards in carbon trading, particularly on quality and accounting of the carbon credits. And so that hopefully we're now moving forward. Once there's an agreement that this is a tool we're going to use, now I think experts have some room to figure out, okay, how are we going to use this tool properly? Let me just end by saying our approach to carbon trading thus far has been, if a client says, so let's say if I get a client who shows up and says, my entire ESG strategy is buying carbon credits, right? And would you, Deutsche Bank, finance me as I buy these carbon credits? The answer to that, I think for most banks, and I'm sure Neha will agree with me, is no. This is not sustainable finance. You can't just, your entire strategy cannot be carbon trading alone. So we look at it as saying, okay, first, are you pivoting towards sustainability? Are you actually changing your asset portfolio more towards sustainable assets? So this may involve divestitures, this may involve new investments, and so on. Second, are you putting effort, both capital and mind share, into improving the performance of your operation so you're more efficient, more transparent, and so on and so forth. So that's second. And then third, are you incentivizing your partners? Very important for trade finance. Who you buy from, who you sell to, are you, the whole idea of sustainability of design and so on. So are you doing all this right? And fourth and last thing, if there are residual emissions, for example, that are still not met and cannot be met 100% at this point, then yes, you can use some carbon trading to offset those. But it cannot be that you start with carbon offsets and forget about everything else.
Okay, great, Kamran. Thank you very much for this great input. Now we definitely go to Neha. Neha works with Bank of America. She's based in India. So my question specific to Neha is that I see a lot of RBI, the Reserve Bank of India, is putting a lot of focus on ESG, and the entire banking system I can see is geared and towards the same thing. And a very large initiative in India on the solar side. I would like to have your inputs, Neha, on this particular changing environment in India.
Thanks, Tony, and thanks, GTR, for having Bank of America. We're happy to be here. So yes, a lot of things are changing in India. We're seeing a lot of activity on the regulations side as well. You would have heard of, the Securities Board, Exchange Board of India, looking at making mandatory reporting for ESG for 1,000 listed companies, the top 1,000 by market cap. This was something that was voluntary, continues to be voluntary for this financial year, but going into the next financial year, this has become mandatory. So this is, again, we've been talking about standardization of reporting and sharing information and data. This is a move towards that, where this, SEBI does have a format, but they've also issued a guidance saying that if companies are already using, things like SASB or GRI or TCFD to, make their ESG sustainability report, then they can include that and then cross-reference what, the format is. So in a way that is, trying to remove the information asymmetries that exist, helping people to understand, through a common language, what each of these areas translate into in terms of, business. We are also seeing a lot of activity from companies themselves. We've been engaging across the board with companies across the sectors, from inherently sustainable and green companies to guys who are doing, a regular business and wanting to look at transitioning, along the sustainability path. And I think our role as the bank, you would have seen our global commitments that we've announced, putting $1.5 trillion across ESG linked to sustainable development goals. We have a very focused team that is cutting across all the 8 businesses that we run at Bank of America, looking at just deploying and scaling up capital deployment in these areas. And coming to India and coming to Asia, we are seeing more of our engagement centering around what does ESG mean for my business. There are these different frameworks, there are these different KPIs and indicators, etc. How does that translate to a very tangible thing for my business? And I think it's our role at the bank to translate this for each of our customers and work with them to not only support inherently low carbon businesses, but also look at people who are transitioning. So transition finance is a big focus for us. And we work with our partners, we work with our clients to help them achieve that. Where there are, very clear-cut KPIs, it's fairly simple, where you'd be working with sustainability-focused businesses. But other sectors would, take more work, take more time, and we would be offering advisory, we'll be customizing products and services. What we also, like to do is not, and trade finance actually gives you the opportunity, like Kamran said, not just limited to what your clients are doing, but increase the ambit of influence and work with our clients to help them then work with their stakeholders, like suppliers and buyers. So we do have products that cater to, sustainable supply chain financing, as it were. So yes, there is a lot of activity in APAC, in India specifically, and we are happy to be, at the center of that and supporting our clients on their journey as they transition.
Thanks, Neha. So just as I speak with you all, we have lots of questions our way. So let me, very interesting questions which are coming. I think one question I would like to, since we have quite a lot, I would like to combine one question specifically on coal. So the question from audience is purely after the COP meeting, coal was identified one of the top problems. So the question from the audience is, why can't authorities immediately impose fines and penalties to organization or close down such business? That is question one on coal. And I would like to combine this with another question on coal, is that eliminating coal is easy from a developed or a Western lens. How do the developing or the underdeveloped country sustain if we just eliminate coal? So purely this was a question on coal, and pretty interesting that from audiences. So I would like anyone to take in our team this question.
So, Tony, I can give you some perspective, and this is the debate which goes on. If coal, why not other fossil fuels? Why not meat? And why not, the digital economy, including, your cryptocurrencies? Because that is where the biggest, emitter of pollution is there, right? So that's the fundamental question we need to ask. It's all, we talk about coal, but we don't talk about the other things because it's a taboo, or maybe it's part of the culture. So that's one. The other thing, as far as the developing nations and the developed countries are concerned, look, as Neha mentioned, right, there is a transition which is going to happen. So look, this will have to be managed. You can't just really say, look, stop a certain activity today, because emerging markets, especially, Asia and those who are developing, will have to manage the social impact of this. Your power cuts in, say, China or in, say, India or somewhere, people will be on the streets because their livelihoods will be lost. So there is a transition which needs to be managed, and I think it has to be done well. And one of the things which Kamran mentioned, and it is relating to the question on and the solution, which is incentivizing, companies and countries, right? And I think that becomes very, very essential. Carbon tax, carbon inflation, and carbon incentives. I think these are the things which are going to make the investments viable in new technology. And it has to be viewed from that perspective that, look, is there any sufficient incentive and, cash flow coming in to basically manage the transition? Otherwise, the transition is not going to happen. See, one of the things which the supply chain squeeze which has caused is huge inflation over the last, 1 year, which we talk about, right? I would say it is to an extent good if you want to drive investments, especially in the new technologies and the new economy, because as your revenue stream and your profitability and cash flow increases, we will see more investments coming in, and that is going to basically end up getting us into the transitioning into the new tech and the transition from coal and the other fossil fuel and other highly polluting industries. So I think it has its time frame or maybe a period, and I think it has to happen gradually, and it will happen.
So let me, if we have time, let me just add a couple of points to what Gopul just mentioned. So first, for the audience, the questioner, the one very fundamental reason why countries find it very difficult to get rid of coal entirely is because of the impact that would have on the social issues, okay? Particularly the communities who are not well equipped to take that kind of shock. Now, having said that, it is also true that coal is indeed quite polluting, and there are alternatives to coal. So when people ask this question, they have a legitimate point to make. And in many of the markets around the world, we're seeing that the price of renewable is already at, in many cases, below coal pricing. India is a good example of that. So clearly, we have the wherewithal to be able to provide alternative energy sources. And people are asking, especially the young people, you know, who are in full force in Glasgow, saying, well, why won't you invest the money that you're investing in coal into this stuff, so into alternatives, so that we continue to make progress? And, you know, as someone who has worked in emerging economies all my life and done development finance with World Bank and places like that, I can tell you that developing countries have a knack for keeping bad policies alive in the name of the poor. We subsidize the rich in the name of the poor for water. We do it for electricity. We do it for transportation. We do it for a variety of reasons. So there are some very legitimate points to be raised about coal. The good news and the bad news coming out of COP on coal. First, the bad news was that we did not reach an agreement that says cut coal by such and such date. In many of the Asian countries, some developed and some most of them underdeveloped, but some, I should say, developing countries, but also some developed countries had that point of view for various reasons. The good news is that the pattern is absolutely set, that coal is, as was mentioned earlier, on the way out. And the financial markets pretty much have started pricing that, certainly on the buy side. So, you know, that to me is very good news. Many of the countries volunteer to cut coal on their own without there being a binding resolution around it. And that means that momentum is going to continue to go. So if you're a company that deals with coal, let's say a coal manufacturer, it doesn't really matter which jurisdiction you are in and how much protection you get from your own government. I can guarantee you it will affect your cost of capital. It will directly or indirectly affect you. So I think for the globe, this was important in that we are now clearly moving in the right direction. How long it'll take to get rid of coal entirely, I have no idea, but that's okay, because, you know, for so many decades, the developed countries were polluting far more than the developing countries. So it could very well be that we come to a world now where you have one set of countries that are drastically reducing emissions, and then you have another set of countries that are either flat or decreasing at a lower rate. But that's fair, right? And hopefully the balance in between will get us to somewhere around, if not 1.5, then 2 degree temperature rise targets.
Thanks, Gopul. Thanks. Now, too many questions, but still I would like to, this question again, I have no choice but to tell Kamran to take it, because again, it is on COP26. And it says that, what was the point of the global event like COP26 if to showcase a united front if the Chinese leader does not attend it, and we get the power to dilute the wordings of the agreement? And the second question, since we are short of time, is also on what are the predictions of where this conversation will be to get to COP27 or 28? Does the choice of venues make the risk of greenwashing even greater?
Yeah, so let me try to answer this quickly so other can chime in. Look, an organization like COP, the conference like that, does not depend upon one leader or one country. And their presence is not all that is made out. The politicians like to do that and say that is in itself enough. There were plenty of leaders there who did nothing, who delivered nothing for the world, right? So, this was not my first COP, and I've had my share of, World Economic Forum in Davos for many, many years and so on too. I go into these conferences from a very low expectation standpoint. I go in there to say, what can I do as an individual to contribute? And what can my organization, whatever that is, whether it's the White House, which used to be my my organization, or World Bank, and now Deutsche Bank, what can we do to add value? And from that standpoint, I can tell you a lot of the private sector did a lot of transactions on the side. And it's not just private sector, but expert groups, NGOs. So, to the audience, I would say, don't get distracted by what the leaders did or did not do. The change is happening around the leaders, unfortunately, as is true for every other area. And that change is moving, and the financial markets are moving in the right direction. Speed is an issue, I agree, but I'm not as discouraged as a lot of young people tend to be, which is, by the way, very understandable.
Okay, thanks, Kamran. Now, we still have time. So one question comes on the technology side. So it's a very interesting question which talks about what kind of smart technology is going to contribute to the key ESG initiative, where at the same time, we increase use of computing design, devices and tight dependencies. These type of devices are also have an environmental impact. So how do you think that smart technology is going to really help the ESG initiatives?
Tony, I can throw some light because we are in plantation business. So, satellite, imaging is one of the technologies which is growing. Then, artificial intelligence around, managing plantation assets or assets, including automating most of the operation. So, there are many things which are on, at the moment in time, some at experimental stage, some really, at an advanced stage. And I think some of these technologies, including cloud computing, where, you can access the data independently, on your phone, as well as, your global positioning system, GPS systems and sensors. These are the smart technologies. And, there are so many startups which has come basically, now to help, companies and, malls to reduce the, the use of heat, So it's all going on. It's basically driven by cost considerations and also, by, I would say, the intellectual force of the new generation. And we are seeing a lot of change happening, and it will continue to evolve. And there is a lot of support. We can see, IPOs coming, and these new startups getting funding, even though it is experimental and it is evolving into a commercial space.
Great, thanks, Gopul. Now we have a question from the audience, and this question is focused directly to our friend Matthias in the legal space. So Matthias, this question comes from one of our audience directly to you. They would like to hear from you on the legal framework or the evolution in the legal framework being put in place through on all these ESG initiatives.
Yeah, as I said, there's no single legal framework. There are, accounting standards. There are loan market associations. There are a number of associations that are all working towards principles that get us to a more sustainable way to finance. So it's about, on the one hand, financing an activity that is green in itself and monitoring where that money is going, so that investors can see that what they're investing in is helping towards a sustainable way of life, and that's part of it. That we have the integrity, and we are documenting something that gives investors, banks, and lenders the certainty and trust in the products, that they know when they invest in these products, they are certified and have a positive effect on the environment. So that's green lending. Other activities are there, such as transition lending, sustainability-linked lending, to enhance environmental and social performance of companies. So again, we have different products and different products that are being developed in trade finance and other forms of lending. So to give confidence and to give integrity that what is being done can be sustainable. There are certainly issues about making sure that the integrity is maintained. There were comments about greenwashing. So clearly making sure that there are standards of reporting and standards that are adhered to are paramount. That is significant, that everyone has the integrity. So in that respect, the openness of reporting, the standards of reporting are very important for banks that contribute. Their reputation is on the line. So banks, when they hold out a product as having a positive effect on the environment, need to make sure that's the case, and again, have a lot of rules in place. So I think we are certainly developing in that way, and we are trying to work with a number of bodies and governments. Monetary authorities are coming up with standards and policies that are aimed towards these objectives. There are also a number of initiatives we work on as lawyers. There's some organizations that are working to standardize the legal documentation. There are many things we're trying to do to add transparency to the documentation, a single approach to how the documents look, making sure that all the environmental aspects of a document are front and center, that we have defined the role of the ESG coordinator. We understand what that role is. The reporting standards are very clearly set out. So, and that's a very good comment. That is the nirvana we all want to get to. We want to get to a stage where the standards and the integrity in the documentation is there. Everyone understands very clearly what the product is. We are working together with the APLMA, LMA in their ESG committees to ensure that we develop products in that respect. The accountants are doing the same. So, in my industry, we're certainly working towards helping to develop that form of standardization, transparency, and guiding principles that help to align and get us to a net zero position.
Oh, no, thank you. Thank you, Matthias. Also to update all our audience, as that finally ICC has come with a position paper. As you know, they worked with Boston Consultancy, and there was, just to give direction to banks, they have come up with a position paper, and we should be having a new set of ICC rules. They are planning to launch it in the third quarter of next year. So basically, that would be to define sustainability in trade finance. So this new rule book, ICC rule book, will be coming. They plan to publish it in the third quarter of next year. Okay, so I think let's take one last question, and again, it should go to the banks in our team or also anybody else. Is that one of the audience has a big question mark on the behavior of ECAs. The audience feels that the ECAs are not only refusing to finance fossil fuel, but also seemingly unwilling to help finance and help companies. There are a lot of companies in transition, especially in the oil and gas, to sustainable form. Does this point, so the question is, does this behavior from ECAs point back to the lack of their foresight, not only in supporting own businesses, but also investing in new businesses? So the audience feels that the ECAs are really not supporting this transition of a lot of the oil and gas companies who are in transition phase to sustainable forms of energies.
Neha, you want to start and then I'll jump in?
Sure. I think speaking for us, our criteria is not necessarily looking at instant divestments. Like I said, there are industries in transition, and we are working with them, heavily engaged with companies looking at transition finance. We look at the commitment to move to more sustainable practices being key, and then customizing products and solutions and helping our clients through that journey. So at least for us, I can say that we are committed to helping our clients transition.
Okay, so on the ECA question, let me just say, in general, beyond ECAs, transition finance is easier said than done. If I started to list every company that comes to me or every transaction team that comes to me for a transition story, it'll be a very long list, and most of those are not real. And as you go into the details and you start looking at it, you say, I'm sorry, if you want to do this trade as a regular thing, fine, but calling it sustainable is going to give you more ache than relief, right? It's not going to be helpful. So one of the problems that ECAs having work for bilateral institutions in my past, I can tell you that they don't have a whole lot of staff, and they don't have a whole lot of internal frameworks. So even for us as a global bank, when we do these kinds of deals, Matthias explained the legal setup very, very aptly. But at the end of the day, even the EU taxonomy does not provide details on every different type of transaction, certainly not in this part of the world. So you as a banker have to actually know the regional environment, the sustainability, materiality, 2-3 layers deeper than regular bankers. And then you must be able to structure the transaction as a bank very, very aptly to be able to provide a solution. To expect an ECA to come up with that, I think even the big ECAs from big developed economies would be hard-pressed to do that. So I think the standards will come from the TCFDs and whatnot out there, or through bankers like Neha, who are actually providing advisory services and customized solutions to clients. And then those would be somewhat copied, or ECAs would piggyback on a deal done by a Neha, for example. That's more likely to happen. But for us to expect that ECAs on their own can kind of drive this whole transition finance train, I think they would be hard-pressed to even drive individual transactions, let alone the entire trend.
Just one last comment on that as well. If we step back, I think we also need to remember development banks, multilateral agencies have very much been catalysts in this entire market and the early drivers. So IFC, EIB were there to do the first green bonds in the world and have been doing the first blue bonds currently, and are developing blue economy and blue financing as a new wave. So a lot of the agency lenders in particular, multilateral agency lenders have actually been a catalyst and have been there for good. ECAs, the other aspect I think is that the whole role in the whole role and purpose of the ECA generally is to support its export, its suppliers going into different economies. So largely they are working with their home country suppliers to promote trade and supply from their home country. And in doing so, they often have to work very closely with international NGOs, and are subject to that kind of dialogue as well. So their role in life and their purpose is not solely really to develop sustainable financing. They have NGO pressures and have ESG policies as well, but they're primarily there obviously to support the export and manufacturing from their home country as well.
Okay, great. I think we are almost done at the end of our discussion. So I think thanks to everyone. I think we have some key takeaways, especially the feedback that we received from corporate, legal, research, as well as our banking panelists. It clearly says that in terms of a panel discussion, can Asia strike the right balance So I think the question should be more that Asia is critical and most important post all the discussion at COP26, where Asia is critical for this trade-led growth, as well as embedding this trade-led growth with all the ESG initiative. Secondly, the supply chains, which are very critical. Also, thirdly, is also a message to all banks also that clients are transitioning, so need to understand better and try and support, especially as Matthias did mention that he would request even banks to help their clients during this transition phase. And lastly, also ICC is also putting in a lot of efforts. And finally, the rules which be coming in to standardize sustainability in the trade finance space. I think, thank you very much. Thank you everybody for joining this. And we thank the audience for actively participating, because even as I speak, we have more questions coming in, unfortunately. And I thank all our panelists for their frank feedback, and I wish everybody all the best and stay safe.